Welcome to Taking Stock for the week ending the 20th of August 2021, where today Matthew Swartz, our portfolio manager, and myself, Kien, Trinh, stream to you all things share markets. Thanks for joining us today, Matt. I know you've been quite busy managing the Lincoln funds with all the star stock changes over the reporting season, and we expect more changes to our star growth stock universe in September once the stocks are all ranked through our quantitative model following their results. As mentioned in our previous video, we will be moving towards this enhanced quantitative process to ensure objectivity in our decision-making process. The process will be based on ranking stocks on their financial health, their quality and growth characteristics over the last reporting period, and relying predominantly on our quant model to make those decisions will mean that there will be companies in our star growth stock portfolio which may raise some eyebrows. But our back testing has shown that this approach has led to significant market outperformance, even in the last year when value styles were in favour. So these changes are part of our constant improvement process to help our members invest with confidence, control, and peace of mind.
Yeah, an exciting development for sure, Kien, and certainly an approach being embraced by the fund team as we navigate our way through an increasingly volatile reporting period. Now, I noticed in listening to your commentary last week that the team talked about some of the common themes emerging across the market, including a lack of outlook guidance, increasing cost pressures, and either capital returns or special dividends coming from the financials and resources stocks. And this has very much continued on this week, but I also want to pay particular attention to some of the comments you made around some of the emerging risks in resources. Now, over the week, the iron ore price has continued to tumble as concerns of a Chinese slowdown place pressure on some steel prices. And I think it's fair to say that we've been fairly consistent in our comments to clients to be careful of the risks. Commodity markets, as we know, are inherently volatile, and obviously this dynamic can result in fairly quick corrections in share prices for miners. Now, this moderation in commodity prices from record territory will obviously place some pressure on the earnings growth trajectory over the next 12 months. And with the unpredictable nature of the Chinese regime, we see the active risk growing and considering reduction from our growth portfolios. Now, however, from an income perspective, the mining stocks in our income coverage list have extremely high quality operations, low costs, and will continue to generate significant free cash flow into the next 12 months. And although volatility is likely to persist in share prices over the coming weeks and months, the dividend yields are simply too attractive to ignore and ultimately will help us achieve our income objectives over the next 12 months.
That's right, Matt, but we will definitely be monitoring those sustainability of those dividend yields over the next 6 to 12 months. And another active risk we highlighted at the start of the reporting season was this downside risk to the fund managers, particularly with Magellan Financial Group and Platinum Asset Management. Back then, we alluded to the heightened regulatory risks in China, which has put pressure on the Chinese share market. And of course, both Platinum Asset Management and Magellan Financial Group, they have some exposure at around 20 to 10% respectively. Now, during the week, Magellan was sold down after they released their results, which revealed a 63% fall in performance fees. Now, as Magellan continues to grow with average funds under management now at around 104 billion, the fund manager is finding it difficult to outperform the markets. In fact, its global equities funds has now underperformed the MSCI World over 1, 3, and 5 year periods. And this could potentially lead to net outflows as we've seen in more recent months. In addition, Magellan is expected to pay a higher tax rate in 3 years' time, and this will put further pressure on earnings and dividend growth. As a result of these risks, we believe Magellan's attractive dividend yield could represent a yield trap, and we've decided to remove the stock from coverage and wait on the sidelines until conditions improve. In the meantime, though, investors should be careful of holding on to Platinum leading into their results next week around the 25th of August.
Yeah, good point there, Kien. And it is an interesting story. One, the fund team's also been monitoring quite closely, paying particular concern to Magellan's exposure to those Chinese stocks, noting that Alibaba and Tencent were fairly prominent positions in their global portfolios and had been somewhat decimated a few weeks ago as Chinese authorities decided to flex its power on their tech and education sectors. But moreover, we've noticed the company decided to change its reporting on net inflows from monthly to quarterly. And I don't think that was somewhat coincidental that this decision occurred about the same time as when their funds started to experience some larger outflows. So, look, at the end of the day, Hamish Douglas has done an incredible job building his brand, and there's obviously a fair amount of overlap in our respective strategies, biasing growth and quality. But with performance pressures continuing and uncertainty on its ability to grow its investor base, they probably don't deserve the premium that they currently hold relative to other asset managers. And we do agree on that decision of removal.
Yes, Matt, and moving on towards some of our star stock highlights for the week now. During the week, online vehicle classifieds business carsales.com, they came out with a solid result on the back of rising motor vehicle sales, higher listing volumes, and also growth in their international businesses. However, much of the company's earnings were diluted by the recent equity raise of around 600 million, and this contributed to a decline in return on equity from 51% to 24%. If you can recall, the capital raise was in relation to the 49% purchase of US business Trader Interactive. The transaction is expected to close early next month, and so there were no contributions from this business over the last financial year. Positively, though, the Trader Interactive business delivered quite strong revenue and earnings growth over the last 6 months, and this will help the business diversify its earnings through international markets, with the company expected to generate 35% of its revenues overseas.
Yeah, some fairly well flagged, I guess, pressures on ROE with regards to the timing of that acquisition, obviously. But from a fund perspective, we've held a position in car sales for both our growth and income strategies, as well as participating in that recent capital raise at $17. And I thought it was an excellent operating result in total. We were particularly impressed by their investment in digital channels with its new car sales select digital product, allowing consumers to buy used vehicles direct from dealers, reducing the dealer's commission costs, but replacing them with transaction costs payable to car sales. If executed effectively, this is a potential game changer for the company in becoming more of an online transaction platform.
Okay, now speaking about innovation, let's move on to that innovative home appliance manufacturer, Breville. They did announce a solid financial year 21 result with revenue growth of around 27% and earnings growth of 17%. However, the market was not receptive of the announcement and the share price was sold down by about 9% on the day. We do feel the negative sentiment can be attributed to various financial year 22 headwinds cited by management, including logistical bottlenecks, higher supplier costs, and a weaker US dollar. However, we do believe these risks are transitory in nature, with the company planning to raise prices to recoup higher input costs and rebuild their inventory levels, which were depleted in 2021. Also, the company had to cut its dividends by more than a third to help preserve cash to help fund further expansion and investment, which isn't a bad thing for a company that generates over 20% in return to shareholders.
Yeah, absolutely, Kien. Not a yield stock, so we're not too concerned by that. And I actually thought it was an outstanding result, and I was very surprised by the initial market reaction. The result actually could have been a lot stronger if not for the fact that the management decided to pull forward some of their marketing spending. So although the guidance reads a bit cautiously, I think management are ahead of the curve here and will surprise on the upside in 6 months' time. Also noting that the chairman, Steve Fisher, is set to retire from the company's board in November following a fairly long run on the board of 17 years. And non-executive director Tim Anthony will become the chairman. And Anthony coincidentally serves on the board of Solomon Lew's Premier Investments, which owns 30% of Breville stock. So we don't believe there is a high element of transitory risk here.
Okay, and also in other news, we also noticed that Codan, the metal detector manufacturer, they were also sold down despite delivering a better than expected result. And this was also due to the surprise announcements that CEO Don McGurk is intending to retire. And please refer to our analyst commentary for more details. We'll be closely monitoring management transition risks for this company over the next few months. And on the positive side, though, medical imaging company Pro Medicus, they managed to defy expectations by reporting a solid result, which showed revenue rising 20% and net profit and earnings up 34% as well. Perhaps the most significant driver of the market reaction following the result was the significant uplift in profit margins.
Yeah, and aside from that strong performance, Kien, conversations with several of our institutional brokers suggest that the strong price uplift post result was in part attributable to some short covering from hedge funds. Some of these, some of the funds have been shorting the stock on valuation grounds, and it's not surprising that you see that given the eye-watering multiples. But those that are determined to bet against this company continue to lick their wounds and count their losses. This was one of those results which is incredibly hard, even for short sellers, to criticise. The business model has proven to be resilient in this highly disrupted period. They've achieved margin expansion, incredible profit growth, and importantly, they continue to win market share, which is a clear indication of the quality of the product. So, my opinion hasn't changed on this one. The runway for growth appears very, very long here.
Yeah, that's right, Matt. That's why we don't put too much emphasis on valuation when we build our portfolios. Most quality companies tend to trade at a premium to the market, and it's also good to see significant skin in the game with CEO Sam Hupert continuing to hold a 26% stake in the business. He has delivered exceptional returns to shareholders and yet appears to be modestly remunerated. Pro Medicus has now grown over tenfold when we brought it in March 2017 at a price of $5.31. Now, turning our attention now to the corporate calendar, there are numerous companies reporting next week because it's reporting season, but please refer to our corporate calendar to stay abreast of all those company announcements. Also, for trend-sensitive investors, we had Ramsay Healthcare turning bullish on the SD Max, Mount Gibson and REA Group also turning bearish on the SD Max. Meanwhile, there were no changes observed on the SD30 TSR, which is the 30% stop loss. For Under the Microscope this week, we cast our attention to Australia's largest commodity producer, BHP Group, who announced a number of key developments. BHP plans to sell its petroleum business to Woodside via a scrip offer. This will see BHP shareholders own 48% of the combined Woodside business. So how does the deal benefit both BHP and Woodside shareholders?
Well, from BHP perspective, we think it's a significant step towards establishing, I guess, that low carbon footprint that they've been talking to by shedding its oil and gas operations and investing in potash assets in Canada. BHP shareholders will benefit from these long-term drivers with high demand in copper for electrification, nickel for batteries, and iron ore for greener infrastructure.
But the recent share price weakness for Woodside does suggest that the deal has little merit for the company. Management continue to point to the benefits of the deal, including synergies, greater scalability, and geographical diversification. But there are still a number of uncertainties on the horizon. Although the company did recently move to a satisfactory financial health rating, Woodside did slightly downgrade their production guidance for the full year. Investors will be questioning also whether the price paid for BHP's petroleum business is reasonable, especially given the aging oil and gas fields in the Bass Strait, which also comes with environmental liabilities as well. And also consider what would happen if oil prices move lower. There are also concerns of a share price overhang, which could weigh on the Woodside share price, assuming BHP shareholders will be selling the Woodside shares they received.
Yeah, there's a lot of moving parts this week for BHP with this sort of spin out of the assets with Woodside. Also part of this announcement, the BHP Group announced the 20-year-old dual listed structure, that DLC structure, will see all of its shareholders transferred or unified to the Australia-based BHP Group. Now, this announcement created some immediate share price volatility, and I'll try to provide you with some context here. So the DLC was created for one reason. It was the most tax-effective way to execute the merger between Australia's BHP Limited and the UK's Billiton PLC in 2001. Now, throughout this time, the shares between the two have not been fungible, meaning you can't buy stock in one market and sell it in the other. Now, although shareholders in both companies received the same dividend payments and were afforded the same voting rights, the ASX and UK listed shares tended to trade somewhat differently, and the Australian shares typically commanded a premium because of the added value, I guess, or perceived added value there from Aussie super funds and the utility they get out of franking credits. So when this unification announcement was made, there was obviously an immediate arbitrage opportunity presenting itself, which saw some very fast money hedge funds simultaneously buying the PLC in the UK and short selling BHP Group. This was in part why investors would have noticed the BHP Group was extremely weak on the day of the announcement, while the UK shares actually traded a bit stronger. But despite all this, and that arbitrage opportunity will obviously diminish, we continue to hold BHP as a star income stock and in our income portfolios due to this excess free cash flow that we see as being sustainable over the next 12 months with an attractive yield of a nearing grossed up 14%.
Reporting season is a time when many companies go ex-dividend, and we've had a few income investors ask us whether it's a good idea to buy a stock right before they go ex-dividend. First of all, Stock Doctor has a raft of features that provide our income investors with insight into upcoming dividends. You've got the corporate calendar allowing you to see upcoming dividends for our star stocks within your portfolio, or the watch list, or simply all companies in the ASX 300. Under the Tools tab, you can also select pending dividends to see a list of companies that are expected to go ex-dividend, and you can even sort this list by ex-dividend dates, for example, or gross dividend yield. Our alert manager can also remind you if you set the number of days you want to be alerted before a stock goes ex-dividend, and this can be found under notification alerts. Also, on the 9 golden rules screen, you can see the ex-dividend date under corporate events at the top, or sitting above the star income stock criteria. If you click on the dividend tab, you'll also find a history of the company dividend payments and franking credits, its forecast dividend yields and dividend charts to help you understand the track record of dividend payments.
Well, lots of incredible features there, Kien, but shall we get back to the question? Should you buy into a stock right before reporting season to pick up the dividend? And although it's a simple question, there are many factors involved which need to be thoroughly considered. So first of all, investors need to consider the 45-day rule, which requires investors to hold shares continuously for 45 days before they are eligible for the franking credit. This is to help manage what's known in the industry as called dividend stripping, a term that refers to the practice of buying shares for a short period of time to pick up the dividend and selling them very soon after the stock goes ex-dividend.
That's right, Matt. And another factor you need to consider is the stock price trend as it approaches the ex-dividend date as well. If a stock has risen significantly leading into their results and dividends, then there is a risk that you may suffer a capital loss that outweighs the dividend you receive once the company goes ex-dividend. And a perfect example of this during reporting season we saw was with regards to Rio Tinto after they went ex-dividend.
And thirdly here, you also need to consider the market environment. In theory, a stock tends to fall in value that is in part equal to the amount of the dividend paid on the ex-dividend date. In a bull market, there's been some evidence to suggest that about 79 to 80% of large cap stocks tend to retrace back to the relative price prior to the ex-dividend within 15 trading days. However, one thing to keep in mind is to avoid buying into stocks after they have released negative results, obviously, because it can place more difficulty for these stocks to recover in the short to medium term.
However, Matt, the risk of losing money by buying into a come dividend stock is minimized if you invest over the longer time horizon. And in our previous research, we do understand that the optimal time to buy into a stock for its dividend is around that 45 to 60 day mark prior to the ex-dividend date. Over this period, share prices do become increasingly supported as investors and funds chase dividend yields. That's all we have time for today, Matt, and thanks for taking your time out, especially during this busy period, in sharing with us your insights today.
It's been my pleasure, Kien, and thanks again for having me.
Thanks, Matt. And with reporting season now in full swing, I want to remind investors to be vigilant and take advantage of the features of Stock Doctor to help you actively manage your portfolio. Keep track of the heightened active risks within the analyst commentary so you can position your exposures prior to the company announcements. Also, for income investors, there are a raft of areas in Stock Doctor where you can find dividend information to help you identify past dividend trends, alerts you to upcoming ex-dividend dates, and inform you of forecast dividend yields as well. And if you have any issues, please contact your relationship manager. Have a happy, healthy, and prosperous week, everyone.